Okay, guys, back for the last piece. I'm a wee bit frustrated because I've recorded this twice already and it won't save, but I think I've solved that. And if it doesn't work, I'm going to smash this iPad to pieces. But here we go. Our last big topic, and it's really important, especially for what is going on in the markets today, is this idea of timing the market. Timing the market means trying to determine when to jump on the roller coaster and when to jump off. Like you're timing to get in when it's cheap and out when it's at the top and then back in when it's cheap, that kind of thing. Okay? It's really important. I'm going to show you why this matters so much. So the idea is that a lot of people believe that if they study hard enough or listen to experts, they will know when to sell before a market goes down and when to buy when a market is low and is going to go back up. Okay, that's this idea. But we know this is fundamentally impossible and can't be done. And we know this because we can just go back to the research we saw pertaining to actively managed mutual funds. Actively managed mutual funds are run by experts who study the markets all day, every day. And we showed that the vast majority of them can't, over the long term, even beat the average market return. So you would think if they, being the experts, knew when to get into a market and when to get out, and knowing they have full control over how they run their mutual funds, if it was easy to do, they would just do that and make lots of money, but they don't, and in fact, they can't even beat the market average. So if they can't do it, why do we sometimes feel like we can? And that's sort of the point. And the truth is we can't. Even Warren Buffett says that he doesn't know and doesn't even try to guess. He was asked by a journalist once, as one of his more famous quotes, as to what his favorite holding period was for a stock, meaning how long would you like to hold a stock for if you could, and his answer was forever. He would like to hold stocks forever. He doesn't try to buy and sell and buy and sell and buy and sell. Okay? All right. So in the long run, you're better to buy index funds, buy whole markets or whole asset classes, and never get off the roller coaster. I think in the long run, you're going to be well served by that. So just before I show you this study, let me jump back over to this thing. And I want to answer a couple of questions I get quite often, and they're good questions, and we need to discuss them. The first one is, when should I invest a lump sum of money? So let's pretend you received a $12,000 bonus at work. People will say, well, should I invest all $12,000 now? Or should I wait for the market to go down and then invest? Or should I invest, say, $1,000 a month for 12 months? Something like that. Those are choices. And they're great questions. So here's what we know. 70% of the time, the stock market is going up. And about 30% of the time, on average, the stock market is going down. So just based on that, statistically speaking, it would make sense that if you got a $12,000 bonus, you should put it in to the stock market immediately, because there's a 70% chance the market will go up after you invest all that money, and only a 30% chance it will go down. And even if it does happen to go down after you invest it, we all know that if you just wait, it'll go back up and continue going up from there. So it's not like you're ever going to permanently lose money. Okay? So lump sum investments, the general consensus is to just invest it immediately and wait, just like we do with all money we put into the market. Okay? The second question is, well, should I invest, say, $1,000 a month over time? No, for the same reason, because if you do it every month the market is probably going to be higher than it was the month before, so you're buying into higher and higher markets, which doesn't make any sense. Okay? Now, what about the idea of waiting for the market to go down? So these are people that say, I am not going to invest in the market every month, which is what I, Barry, think you should do, and I do with my own money. People will say, will instead put my money in the bank every month, and I will just save it in a high interest savings account. And then when the market goes down, say 25%, then, sorry, that was kind of ugly. When the market goes down 25%, then I will put my money in and I will buy at a good discount. Okay? And on the surface, that seems like a smart move. So it might look something like this. Let's say we have a market that's going up, right, over time. And eventually, at some point, the market will indeed go down 25%. It has right now, for example. It's gone down anywhere from 30 to 35%, depending on what market. So say the market takes a significant dip of 25%. Okay, at a time like this, many people, including some of my colleagues right now, are walking around pulling their hair out saying, oh my goodness, my stocks have lost so much money. It makes me sick to my stomach. I can't believe it. And I had a conversation like this with one of my colleagues just the other day, and I said, this isn't a problem. You just got to wait. It'll go back up. It always does. And in fact, try to invest more money now if you can. And I had to sort of try to calm them down, right? Because this is stressful times for a lot of people. It shouldn't be. It shouldn't be. And for you guys, again, market declines are great opportunities to buy more if you can, if you have access to money. And I put my money where my mouth is. My wife and I are still going through the process of having a line of credit set up on our house. We had an appraiser, and on Friday, we're trying to get this done as fast as possible so we can borrow. We're going to borrow $200,000 and invest more. I practice what I preach in class. So I think that's what we should be doing at times like this. Now, back to the question on the screen though. What about the people that say, I am going to save up my money and wait for the big market declines and buy then, and I'll be farther ahead? Okay. The most likely problem with this approach is illustrated here on the screen. Okay. At times like this, where that person says, I'm so smart because I took all my money out of the bank and I invested. And let's say they caught the absolute bottom of the market before it started going back up again. At this point, exactly at this point right here, okay, they're walking around the office smiling and very casually slipping in a conversation about how smart they were. And they're like, oh, I've been waiting for this. I knew it was coming and I bought now at a 25% decrease. And all their colleagues are like freaking out because they don't know better. And they're all, upset that the market's down. You are, strutting around while everybody else is panicking a little bit. The problem is we're looking at this on too small of a window, because what the person who's been saving up here and only invested when the market went down hasn't said, noticed, or realized is that they missed all this. And depending what period of time you look at over a historical stock market chart, there's only so many really big decreases to buy into. And often while you're waiting, you're missing so much upside that your results aren't actually going to be that good over time. I mean, sure, the person that buys on this dip gets this profit, but they missed this one. And I think that's a problem. So I think the proper way to approach this is to just buy either every month or every paycheck. Just keep buying. Warren Buffett said so in that video we saw a few minutes ago. Just keep buying, and sometimes you're going to be buying high and sometimes you're going to be buying low, but over time you're going to make lots of money. And when these major dips happen like this, or like what's happening right now, is to just try to get access to more money if you can. And if you don't have access to money because you can't remortgage your house, you don't own a house yet, you don't want to remortgage your house, whatever, your spouse doesn't want you to, big deal, just get on with life and just keep investing, and over time you're going to do just great. Okay, but saving up your money in the bank, waiting for the next market decline, isn't a great strategy, because you could be waiting years before you get that chance. And then even though you get to buy in the dip, you miss all the growth while you're waiting. Okay, I hope that was clear. Okay, so we're going to look at one more little rant. I'm going to pull up a graph here of the S&P 500. So we're going to look at it for 5 years. If I can get it up here, come on. Here. All right, so there's the S&P for the last 5 years. So notwithstanding the last 3 weeks, which has been a really precipitous drop, I want you to start on the lower left and ask yourself as you're moving across this 5 years, 1,500 days, really long, more than that, long period of time, how many times does the stock market reach a new high? Again and 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 again. And in a bull market, on average, the stock market will hit a new all-time high. I'm making air quotes. You can't see it. All-time high every 14 days. Which is why somebody needs to pass a law to stop the stupid media for saying that the stock market's at an all-time high. Are you kidding me? Of course it's at an all-time high. It's always going to an all-time high. If it wasn't always going to an all-time high, we would never make any money. I hate that phrase. Please don't let it sway you. Okay, so back to the slides. We're going to look at an example here and then call it a lecture. Okay. I want you to imagine you got $10,000 in a bonus on January 1, 1995, and you decide to invest it in an S&P 500 index exchange traded fund. Super low fee. It's going to buy the whole S&P 500 for you, and you're going to leave it there until December 31, 2014, which is 7,300 days. And you're not going to look at it. You're not going to touch it. You're not going to sell. You're not going to jump on and off the roller coaster because you remember that dead people make the best investors, right? So you're going to leave it there. And once you finally look 7,300 days later, you're so happy to see that you made a 9.85% compound average rate of return. Amazing. Right? Right in line with historical averages. Good job. And you will find that your $10,000 has grown to over $65,000. You've made a 650% total return. Awesome. But the question is, what happens if you miss the 10 best days out of 7,300? Can you imagine that? Because you're trying to get on and off the roller coaster and you're listening to idiots on the news, you've missed the best 10 days that were in the market. Kind of like my wife's family, who over Christmas said they didn't have their money invested in 2019 because they really felt the market was due to go down. They were like, I really thought it was going to go down. And they missed out on 30% returns. 30%. Like, oh my God. So what if you just missed the 10 best days out of 7,300 days? How would that change your returns? Or what if you missed the best 20 or best 30? The results are dramatic. If you left your money invested, you made your 9.85% of return. You got 650% cumulative return over that time period. You did great. If you missed just the best 10, your returns dropped to 6.1% for 10 days. 10 days out of 7,300. And you only made $32,000. You made half as much money because you missed the 10 best days. Now, I just want you to ask yourself, who exactly do you think it is that somehow knows which are the best 10 days out of a 7,300 day period? Anybody? Nope. There's nobody. Nobody. If God exists, it's God. That's it. There's nobody on planet Earth. Nobody could possibly say. Or what about if you miss the best 20 days? Your returns drop all the way to 3.6. If you just miss the 20 best days out of 7,300 days, your returns drop to 3.62. Now you're barely beating inflation. And if you miss the best month, you're not even beating inflation now. So if you play this get on the roller coaster, get off the roller coaster game, you're going to lose. And your returns will drop so much. And when your returns drop so much and you're listening to the idiots you work with who think they're stock market geniuses and everybody has an opinion, or you're listening to the talking heads on the news, and you get these really bad returns, you will say things like, the stock market's gambling, it's like a casino, stocks are risky, you can't make any money with them. Well, you can. You can make lots. You just have to do it right. Which is why my first lecture on investing was literally to say buy all the boats and don't get off the roller coaster. That's all we talked about. Because it's so important. It's so important. If you do it right, you'll make lots of money. If you do it wrong, you won't make any. Heck, You might even lose money. So I've recorded this thing 3 times now, and I feel like I haven't said it this time, so I'm going to say this again. If I have, just fast forward. I'm sorry. Please, please do not listen to those people on the news or that write blogs or write in the newspaper. I don't care if they're on CNN, BNN, Bloomberg, Fox, like nothing. And they all pretend to be business people, and they all pretend to be investing experts, blah, blah, blah. And they sit up there and they will say things like, the stock market's at an all-time high. We're long overdue for a stock market correction. I really think the economy is overheated, blah, blah, blah. Nobody on this planet could possibly tell you which are the 10 best days or even the 10 worst days out of 7,300 days. Nobody. They might guess right by some completely random fluke. How could they possibly know? Nobody knows. And here's what you have to remember. The people that say this stuff are saying the thing that's easy to say. Do you know how easy it is to say, be careful, be cautious with your money, you don't want to lose it, the markets may go down. And then when they're wrong and the markets went up, they say, well, our data really suggested it probably was going to, and I was just looking out for you. I really didn't want you to lose some money. It's easy to be the negative people. It's hard to be the positive people. It's way harder for me to say, put 100% of money in stocks, keep investing, keep your foot on the gas, and ride the roller coaster and never get off. Because when you follow my advice, you have to follow the hills all the way down and then rocketing all the way up, and your stomach feels those lurches. That's tough advice, but it's good advice. The getting on, getting off, look at this table again. That's terrible advice. My wife's family member who missed out on 30% returns in 2019. I just want to bang my head against my desk just thinking about that. Whoever it was they listened to that gave them that advice suffered nothing. Those family members suffered everything. They lost 30% returns. Are you kidding me? 30% returns? Whoever it was, whether it was a culmination of news broadcasts over the last 18 months or stuff they read or some friend who told them the market was probably going to go down, they didn't suffer. There's no ramifications for them. It was the people that lost 30% returns because they weren't in the market. They're the ones that suffered. And you're the one that's going to suffer if you listen to these people on the news. The joke we use is that the pundits on the news that are always calling for recessions and stock market declines have called 11 of the last 2 recessions. Because they say it over and over and over and over and over and over, and eventually they're right by random coincidence. It's like if I started saying in July that it was going to snow tomorrow, I'm going to be wrong until someday I'm finally right. But the day I'm right doesn't make me a genius. Of course it's going to snow someday. And yes, the markets are going to go down someday. And yes, the economy is going to go into recession someday. But nobody knows. So please don't listen to them. Look at this chart. You have to put your money in. You have to keep it invested and just keep shoving money in. Remember, dead people invest best. Okay? So one more thing looking at this chart. All these people, whether it's the investment advisor who tells you 4%, or your friends and neighbors who listen to the news and then pretend to be stock market geniuses and whatever, or the people that say, oh, you should sell now and buy later and blah, blah, blah. They're just talking. You have to look out for yourself, okay? I have no financial gain to get as a result of the results you guys earn. I just want what's best for you because I want what's best for you. Whether you guys make money, don't make money, follow this advice, don't follow this advice, doesn't change my life a bit, but I really hope it changes yours. I have no bias here other than to teach you what I truly think is best, and I live everything that I'm teaching you guys. Every single thing I teach you guys, I do. All of them. Okay, so I obviously believe it, and I just want what's best. If you can earn these kind of returns, like 9.85%, by not getting off the roller coaster, by not putting bonds in your portfolio, by having 100% stocks, by diversifying, by using index ETFs, and by paying very low to no fees, you're going to make a lot of money one day. But if you put bonds in your portfolio, you pick actively managed funds, you pay high fees on your funds, you try to time the market, you listen to the people on the news, there's a really good chance you're not going to do very well. And I want you guys to do great. Index funds, 100% stocks, diversify your portfolio, low fees, and don't get off the roller coaster. If you do those things, some days when I'm long dead and gone, you guys are going to be really, really rich, and I'm going to be really, really happy for you. But we got to do it right. Okay, I'll see you in the next lecture.